Good afternoon, guys. JR with Secure Metals Exchange, bringing you another technical update for both gold and silver today, Wednesday, November 28th, 2012, and it's approximately 12:31 p.m. Eastern Standard Time. I'd like to wish all of you guys, I hope all of you guys had a great and a happy Thanksgiving. I hope we were all able to spend some quality time with the families. And without further ado here, let's get to the technical update here. So we're looking at the daily chart here for gold. We saw a pretty decent sized dip this morning here on gold. The market opened up roughly at around 1741, and we had a big move to the downside. Apparently this morning there was a sell order for roughly 24 tons of gold in futures contract that was sold this morning, and this was able to manage. This managed to push the prices back down all the way down to retest the 50% Fibonacci retracement. Now, remember, for the last 2 months, we've really seen the metals in a very nice rally. Actually, this rally started back roughly in the middle of August. It extended all the way up to the early October and came back down, tested the 61% Fibonacci retracement, and came back up to test the 1750 or the 23% Fibonacci retracement. Since then, we've come back down to 50. And as of right now, the stochastics are pointing a bit lower, so there is a bit more room for a further decline. What we don't want to do is we don't want to fall below 1617. If we do, then this whole area will be exposed, okay? But as of right now, it doesn't necessarily look like that's going to be the case. I actually did anticipate a little bit of a move to the downside. I actually made a video last night. I was actually going to upload it this morning here, but by the time I was going to do that, then this market already had fallen. But I actually predicted a move back down to here simply because we had a little bit of a negative divergence here. If you come from here and you go up, and you come from up here and you go down, that's a bearish divergence, as well as this is also a bearish divergence as well. So no matter if you were looking at it from here or from here, we did expect a pullback. Again, I anticipated a pullback to around the 20-day moving average, or the 38% Fibonacci retracement around 1727. We actually came down this morning to 1706, and as of right now, we are still holding above this trend line here, okay? So again, you know, manipulation is going to come. These guys are not going to allow this market just to continue to rally forever. You know, again, a big sell order, nothing changes. We still have the fiscal cliff ahead of us. We still have the European debt crisis, and we're still printing $85 billion a month, until the end of December, which after that, unless they extend Operation Twist, I don't necessarily see that happening, because we already have a $40 billion open-ended quantitative easing policy, and that's obviously open-ended. It could go on until the end of next year. But the great news is that a great buying opportunity. So for those of you who were paying attention, I hope you were able to get in at these levels. I will continue to accumulate until these levels here. After that, we're going to just let it rest and see what happens. If it continues to go down, I do expect those dips to be very well supported the way this one was. Again, I don't really expect this thing to continue to go down further. But, you know, we do have to keep our eyes open on that. If we look at the weekly time frame, the chart really just looks amazingly beautiful. I mean, it doesn't really get any better than this. This is just an extremely bullish chart. But again, if we look at this weekly chart, the stochastics are pointing higher, so there's still a good chance that we're going to continue to go higher and test this 1800 level again. My guess would be that by the end of this year, we've already tested the 1700 range, possibly even the 1900. Who knows? But I would definitely, if I'm gonna put some money on it, which we obviously do, I would say that by February or March of next year, we're gonna test this $1,900 price tag. I'll follow that. I'll follow this up with a few articles that I have picked up here in a few seconds. But as of right now, volume is slowing down. Stochastics are pointing higher. We're above all major moving averages. The 20-day moving average is actually, if you notice, is actually pointing to, if this was a clock, it would probably be pointing to about 1 or 2 o'clock. Let's say 1 o'clock around here. Is actually very nice. That's a very nice bullish pattern. I don't expect this thing to go further down than this. If it does, then I would probably target around 1630. And from here, I would assume that this thing would continue to go higher based on the current gold demands that we have. If we look at the silver chart, same thing. We did see a big pullback this morning, but it probably erased already more than 50% of its pullback. Again, that shows extreme amounts of support here on this sector. As far as silver goes, again, we did expect a little bit of a pullback, and again, I did kind of expect a pullback, a nice pullback, simply because it's just common sense that these manipulators are going to try to kick everyone out of the market. The one last scare before we continue to go higher, but I do expect this market to test this $37 range, this $35 range, at least by the end of this year. I would hope that it tests $37 by the end of this year. But again, if I have to make a prediction and put myself out there, I'd predict $37 by the February or March time periods of next year. Okay, so we still have a lot of upside. I don't really see, I think the downside is very limited. The stochastics are on the high side, but again, still plenty of room to continue to go higher. And based on this negative divergence that we see here, again, we did expect a pullback. The great thing is that, I mean, we're looking at this. If you notice this, let me zoom in here. What you'll notice is a big candle here. You see a big wick. Anytime you see this wick, again, prices came down to 32.89 this morning, and we're already back up to 33.70. So again, lots of support here in this market. And I guess at this point, you know, again, the trick is don't go too aggressive, and you'll be fine. If you're not going crazy here, you should be able to make a very nice profit here. If we look at the longer term time frame here on silver as well, beautiful chart here, very nice, very bullish. Stochastics are still pointing higher. So again, I would assume that we're going to try to test this level here, the $36 level, the $37 level here by the end of this year. We came down here, came down to, again, 32.90, 32.89 this morning. And at this point, we just want to see if these levels are going to continue to hold, and we're going to go a bit higher here. All right. So on the daily chart again, I think I already put the daily chart, right? Yeah, I did. So you guys saw the daily chart. On the daily chart, stochastics are a bit higher. As of right now, we're still above all major moving averages on both the daily chart and the weekly chart. And at this point, it's just a matter of waiting. You know, we have the fiscal cliff coming up. I'm pretty sure everyone's getting nervous about this fiscal cliff. I really want to say that I think the fiscal cliff is a joke. You know, what these guys are doing is they're trying to scare the crap out of everyone so they can justify raising taxes. Maybe if they scare the crap out of us, maybe we'll agree, okay, raise taxes because we're afraid. You know, the fact of the matter is these guys, you know, I guess this guy Norquist has been getting a lot of heat, and he does not want to compromise. He does not want to raise taxes. And he's standing by that. I actually praise the guy because, again, he's standing firm. And really what we need to do is cut down on spending and not really cut down on spending and not ask, why would we want to get ourselves into more debt? I'm going to show you guys something that I think it's pretty cool. I've shown this site before here, usdebtclock.org. It tells us all the figures of the U.S. Right now, our national debt is $16 trillion. If you do the math, actually, it actually breaks down the debt per citizen. Okay, so right now, the debt per citizen right now, okay, is roughly $187,000. Now think about that. Because the U.S. government refuses to lower spending, each and every citizen uh, of the United States is basically on the hook for their share of their $16 trillion. Now, the total U.S. debt is more than $58 trillion. But again, when we talk about our national debt, we're talking about $16 trillion. So now another thing that you want to point out is that this is $187,000 per this is $187,000 per citizen. Now, as far as personal debt, we're talking about $50,000 per person. Now, again, being 300 million people in the United States, I believe the census is 312 million people in the United States. If you actually do the math, only 53% of Americans pay taxes. So that basically means that we, the people that pay taxes, that is, we're not on the hook for 50,000 or 187,000. We're on the hook for 100,000. Those of us who pay taxes, and on top of that, we're on the hook for another 300. I mean, it's really sad, to be honest with you. It's really sad that we're in debt more than $360,000 because the government refuses to lower spending. So I just wanted to put those figures out there. This is the what the fund spends every year. This is the budget deficit, and the revenue is 2.4 for the year. So we have basically a government that refuses to lower spending, refuses, and as you can see, this thing is it's really ridiculous. I mean, this is actually scary. I don't even want to look at this anymore, to be honest with you. Paul Krugman is a Nobel Prize winning economist. He did not successfully predict the housing market bubble. He did not predict a tech bubble. He is a very faithful student of the Keynesian economics. He's one of the heads of Keynesian economics, and I normally don't read his articles, but I came across this article and I figured I'd give the Keynesian a shot here, and I actually found this article pretty interesting. The guy actually admits that I guess Bernanke's been getting a lot of heat for the quantitative easing and inflation expectations, and the word around the street is don't worry, prices are really not going to go up that high. We have everything. We have basically everything under control, and no one should really worry. When Krugman is a bit more, I would say, verbal. He's a bit more honest, I guess, which is quite surprisingly here for this guy Krugman, because he actually posted a blog in 2001 saying that what we need to do is we need to start a housing bubble, to get us out of the small recession that the technology bubble got us into back in 2000, 1999-2000. So he actually suggested that we create a housing bubble, and that's what the Federal Reserve and Alan Greenspan did in early 2000. On this article, though, it's a very small article. I'll start reading here. So Fed hawks are all upset that expected inflation has risen since Bernanke announced quantitative easing 3. And down here, is this alarming? On the contrary, it's the main purpose of the exercise. So what Krugman is saying, that the purpose of quantitative easing, the purpose of money printing is it's to raise prices. That's the whole purpose. It's don't worry about expecting prices to go up. That's what we want. We want you to think that prices are going to go up. If prices go up, if you know that we're printing money today and tomorrow your dollar is going to be worth less, what are you going to do with your dollars? I hope you don't keep them in your bank, because you know they're going to come down in value next year. So the purpose of this, he actually called it an exercise. So the money printing exercise, the purpose of this whole thing is to make you spend your money now before prices go up tomorrow. By you spending your money now, it helps the economy. So by you not keeping money in the bank, by you exchanging that money for gold and silver and tangible assets and not keeping it in the bank because you're afraid that the dollar is going to lose value next year, that's the whole point. So in simple models of expectations-based efforts to get out of liquidity trap, the only way the Fed can get leverage is by promising higher inflation once the liquidity trap is over. You can complicate the story a bit. For example, a sluggish trigger finger also means that the expansion lasts longer, and hence that the firms will face higher and real demand. But inflation expectations are the main target, and a rise in those expectations is a feature, not a bug. So what he's saying is that prices going up is not an unexpected consequence. We're not printing money and oh man, prices are going up tomorrow. That sucks. That's an unexpected consequence. No, that's not the case. This is the purpose, okay? So what are the hawks talking about? The problem, at least in part, is that the indirectness of Bernanke's language. And I think that's really what a lot of people or a lot of economists don't like about Bernanke. I mean, it really took him about 10 months of rubbing everyone's belly and saying it'll be all right, we're going to print more money, it'll be okay, we're going to print more money. The market was calling out for money late last year, early this year, and Bernanke did not stimulate until June, where he started Operation Twist again, where he extended Operation Twist, and obviously in September where he went out and did a full quantitative easing or Q eternity, where he's printing 40 billion until further notice. So and that's really what Bernanke's issue is. He comes out, he gives you a little, a little taste, but he doesn't let you enjoy it. And that's really what's happening right now. The way inflation target is implicit rather than explicit feeds the confusion. I understand that what he's doing, a lot of people aren't ready to face the realities here. So blurriness has its uses, and so do other targets like nominal GDP that are ultimately mainly about inflation but do not make that point explicitly. But there are costs to this vagueness, and we're seeing some of them already. So I like the article because, again, he kind of admits that that's really the goal. The goal to printing money is not that Bernanke doesn't understand what he's doing. It's not that Bernanke feels that if he keeps money printing under control, the trick of this whole money printing is not let's print money and hope that prices don't go up. As we all know, inflation comes with its side effects, and one of its side effects is prices going up. When you expand money supply, which is inflation, you usually get prices going up, but you don't necessarily get growth. And I think we've seen that within the last 5 years. That all we've done is print money. So it'll be interesting how Obama and how much money Obama's administration is going to continue to print, being that he's already printed over $5 trillion. So that'll be interesting. I also have a few other, actually, I wanted to put this when I was talking about, the fiscal cliff. And one thing that I want to make sure that you guys all understand is that the United States does not default on their bills, and this is why.
Are U.S. Treasury bonds still safe to invest in?
Very much so. I think this is not an issue of credit rating. The United States can pay any debt it has because we can always print money to do that. So there is zero probability.
And don't worry about printing money, because the taxpayers will pay it. With that said, guys, I hope you have a great week, and we look forward to getting with you guys soon. Bye-bye.